Howdy, Jacob here. Today we're looking at Canadian National Railway Company in the ground transportation industry. As you can guess from their name, they're a railway company. They engage in intermodal trucking and marine transportation and logistics in Canada as well as the United States. 69, almost 70 billion market cap, 83 billion enterprise value. Growth has been fairly lackluster. You're looking at low single digit revenue growth with, however, an increase in operating margin and gross margin. They're very close. Because cost of goods sold is everything. They really don't have that big of a workforce, I guess. Pay a dividend, and it's a good dividend. The yield is 2.2%, but in relation to earnings, it's manageable. Return on invested capital, well above 10%. It's positive. We'll see if they actually reinvest, though. 354 million cash on hand with 1.7 billion in short-term debt and 12 billion in long-term debt. So way more debt than I would like. We'll see from the cash flow statement what 12 billion is in relation to their free cash flow. So their free cash flow produces about 2.6 billion. So 2.5 billion for their balance sheet. Debt would be just under 5 years. So 2.6. I mean, you're looking at a little over 4 years of free cash flow for that debt. And they have 1.7 billion due soon. So they're funding, they're buying back a lot of shares. They're paying a dividend. Although the dividend has a payout ratio of less than 60%, they've been going into debt to buy back shares. I don't think that's absolutely necessary. So again, when we make our own assumptions, we're going to have to balance out what the company's done historically with what you want them to do. So if we start making some assumptions on the revenue growth side, I could see them grow with inflation. I mean, they're really not many acquisition plays here, or at least big acquisitions here. Reinvestment opportunities, which is going to hinder their return on invested capital capabilities because they're just buying back shares and paying their dividend. So maybe 3% market average P and price to free cash flow. Margins are great though, 30, 21. I wish free cash flow were a little bit higher, but I mean, even 30 and 25%. Buying back 1% of shares is about 700 million. Apologies. So if they paid 1.5 to their dividend, 700 million to share repurchases, that does leave about 20% or so to pay down that debt, which I think is a reasonable amount of payout. So let's do minus 1%. And the dividend, I don't need them to increase it anymore, but historically, they have definitely increased it. So maybe I'll increase it a little bit less than their revenue growth, just to say that, they're a dividend aristocrat. They raise their dividends for whatever period of time, and the payout's still getting lower because their free cash flow is growing greater. So with my assumptions, I'm saying it needs to fall a little bit more than in half to get to the return I'm looking for here. So I think railway companies do have some sort of moats. I think barrier to entry is a massive plus for them. But again, what type of premiums? That's the art of investing. What type of premiums do they deserve? But for me right now, I don't think it's too obviously cheap for me to want to get into this company. Hope you enjoy the video and have a great rest of your day. Thank you.